Good morning, and let us see what's happened for the past week, which has been quite interesting. I think our reflation theory has been shot out of the water for the time being. So let us review the fixed income markets. Two-year note basically has rallied all the way back to the top of the Bollinger Bands, negating any kind of bearishness. As you can see here, we have marked some channels that the two-year note is trading in, and it basically went on Friday from the beginning of the week to the end of the week. It rallied basically all week, so negating all bearishness that was evident the week before. As you remember, we were trying to anticipate or predict a break of this level, which never came. Therefore our positioning never changed, thankfully. It never really pays to anticipate a signal. On the dailies, very little change. Basically we just went to the top of the Bollinger Band and came slightly back because we have a lot of issuance next week, which can be better seen in the 5-year note, which is basically trading flat. It's trading in bands. We have this band here, which is the bullish band, and this band here, which is the bearish band. So basically it seems to be stuck in between. When the stock market does a little bit worse, when it's risk off, it basically trades above 120.28 all the way up to 121.19. And when the stock market is doing well and there's risk on, it goes back to 120.28 to 120.04, and that is basically what we've been seeing for the past 3 months. So resolution will come. It's just that it's not going to come anytime soon from what we can see in these markets. The conclusion actually is very useful, because they're telling us that these are trading markets, so trade them. Don't anticipate a break. A break will probably come in several weeks' time. Nothing is imminent, so keep on trading it. 10-year notes, exactly the same. We have marked here the channels in which it trades during bullish periods and during bearish periods. 131.08 to 130.05. 130.05 seems to be a very good swing point. If it breaks 130.05, sell it. It's probably going towards 129. And that is basically the story of the 10-year note. Complete indecision by the market. The market doesn't know whether to be bullish or bearish, and it basically trades in those channels. There's not a lot more to be said for it. 30-year bond, exactly the same. We have marked some channels, 167 to 163.5. 163.5 is the pivot point for bullishness and bearishness. 161 is the level to break on the downside, and basically 167.25 is the level to break on the upside. At the moment it's basically stuck in no man's land. It keeps on going up and down within those bullish and bearish risk on channels, and that is all that it's doing. Extreme indecision. If you look at the Schatz, same thing here until it breaks 111.70 or 111.87. There's nothing really we can say about this market. The bobble, again, very much similar. 131.56, 130.83. 130.83 seems to be some sort of a swing point. 130.38 seems to be the absolute bearish level that it cannot break on the downside, and until it breaks that level we certainly cannot talk about any kind of reflation trade in Europe. The Bund is much the same. 164.60 is the top side. 163.25 is the swing level. 160.81 is the level that it has to break to become bearish. So if it starts trading above 164.60, we can forget about any kind of reflation trade in Europe. And there's no point in anticipating it, because, you know, anticipation just loses your money. So, turning to the equity markets, well, you would not be surprised to see exactly the same kind of behavior by the equity markets. Looking at the cash market in the DAX first, we're still stuck in this descending channel, and we basically keep on trading around the moving averages and the Bollinger Bands. Now, what's interesting is that we are finally getting compression. Next week, we anticipate that we'll go back up to above 10,000 to 10,100, maybe 10,200. This kind of level, 10,137, which is becoming pivotal. And then we will make up our minds again. There is nothing really to be said until it starts trending, and we can actually predict that for the next 2 or 3 weeks we will not be trending. It seems self-evident. On the 300-minute chart, it came down, it tested the moving average. Now it's going to go back up to about 1,095, 1,100, and that is basically all we can do. We can say that it's in a random walk. In terms of bullishness, it goes up to 10,500. In terms of bearishness, it goes down to 9,500. I think it's pretty much stuck in a 1,000-point range at the moment, and all you can do is trade the range, which historically we're not very good at doing, but we have to try it. In the on a very, very long-term chart, you can see that it's basically stuck around this center line. Every few weeks it comes back to this center line, rejects it or not. If it doesn't reject it, it goes about 4 or 5% higher and then comes back to it. So this line comes in at around 10,300, and for the time being we're very much stuck within this area. The Bollinger Bands, even on the weeklies, are compressing, so we'd have thought in about 4 or 5 weeks time they'll be a lot narrower than they are at the moment, and the market will be at a inflection point and a decision time, but certainly not yet. The stocks on the cash side is showing exactly the same. It's a more bearish chart because it's a more bearish, it has a lot more European contracts in terms of Italian, French, Spanish stocks, which are much more undervalued than German stocks, with reason. And until it breaks these moving averages and these downtrend lines, we can't really say that we have entered a new period. It just comes down to the daily Bollinger Band and bounces off it, goes back to the middle, maybe exceeds it slightly. We have this level here at 3,041, which we've been talking about for a long time, that it just keeps on bouncing to and then failing at and then coming back. But again, I think for the next 3 or 4 weeks we're definitely stuck in this range between 2,850 and say 3,048, 3,050. So it's a 200-point range, and we shall just have to trade it accordingly. The US cash market is exactly the same. This is a daily chart of the S&Ps. You can see that we wanted to buy it at 20, the equivalent of 2035, because this is cash. It came within a whisker of it. It came to 2038. and bounced, and now it's probably going to go to the center line as resistance. So we're talking about 2077, which is about 2072 in future S&Ps in the ES. So that's basically all that we can say for the time being. Here again, compression in the Bollinger Bands. On the monthlies, again, all it did, it came down to the EMA, to the 5 EMA in the monthlies, and it's still stuck in this range between 2100 and 2030 until it breaks 2030 on the downside, which we keep on mentioning is a very, very important level. We just cannot get bearish of it. It's confirmed even by things like the transports, which again came down to the bottom of the Bollinger Band and bounced. We are just seeing some excesses being wound off, but there is nothing here which is showing any kind of extreme bearishness. We couldn't close below the previous low, so basically we are still stuck in this range. We are seeing nothing which is really leading these contracts on the upside or on the downside. The more interesting things longer term are happening basically, we think, in the gold market. We are starting to change our mind about the long-term direction of gold. Now we have this very nice trend line here, which has capped it for the best part of 5 years, and we are hoping for some backing and filling towards 1200 before we attack that trend line. We are beginning to think that people are longer term switching away from equities into gold, because they just don't trust the equities at these valuations. We can actually look at some valuations from the Yardeni website, and this is the most interesting chart. Basically, you have flat expectations for PEs going forward, and the market is stuck trading between 16 and 17 times valuations. Well, those historically are extremely high. The Tobin Q is extremely high, and we have a situation where I think more and more people are switching a percentage of their allocation away from equities into something which is non-correlated, something like gold. So long term, we are beginning to be more bullish of gold, and we are hoping to see a retracement back towards 1200. Silver, we don't trust at all, but it's beginning to look extremely positive again with the attack on this trend line. It's already broken that downtrend line, mainly through time as opposed through price action. But you know, if it came back towards the 16 level, we would certainly give it you know, serious thought to buying it. This level here, which is at 18 to 19, if it breaks, we're going to have to you know, throw in the towel and admit that, you know, these gold and silver are certainly in an uptrend. Oil, still in an uptrend, but very much compressing on the Bollinger Bands, on the dailies and on the 300s. On the dailies it's more evident. It's probably going to trade in this area between $40 and $46 for a while before making its mind up. No point in anticipating, price will tell us which. And the dollar index, well, looking from we bounced off the 38.2 retracement very hard. And now we are basically in another period of indecision. On the dailies you can see it a lot better. We have a very nice downtrend channel. We spiked it, we couldn't maintain it, now we're going back up. This kind of level, if it gets all the way to the top of the channel, it's going to be very important. We have the moving average which is turning over, the 200-day moving average which is turning over. We think that the more gold and the dollar are showing non-correlation, i.e. gold is going up even though the dollar is going up, the more we are certain that people are switching their allocations away from equities and back into gold and away from commodity currencies. So we have the situation that the dollar is rallying, which is bearish for the stock market, but stocks are not giving up as yet. This will have to be resolved. The only thing that we are having as trends is the Canadian dollar and the Australian dollar. The Canadian dollar has broken a very steep uptrend and is probably in a period of retracement of this whole move. Now, the retracement of this move is itself a very big deal. At 0.382 takes it back to the moving average, the 200-day moving average at 133. So we probably have another 3-4% of correction in the Canadian dollar, which in itself is probably bearish for oil. This is quite significant, and we have the same thing in the Australian dollar, which has broken its uptrend line and probably will come back all the way to at least 72, if not to these levels here around 70, or maybe even lower. Any bounce in the Australian dollar back to 75 and a quarter, we reckon is going to be sold very hard. And those are the two trades that we're looking at. We're looking at Canada, and we're looking at Australian dollar, and we're looking at the New Zealand dollar, which is still stuck in this uptrend. We probably would like to sell a bounce back up to 69 and a quarter, this kind of level, 68.80 to 69 and a quarter, trying to anticipate a break. We'd sell a little bit here, a little bit more there, and then wait for the break down to occur. If the break does come, 65 is a minimum target. So you're talking at least 3-4% move on a break of this channel. On the dailies, it can be seen it's exactly the same. We would certainly anticipate going back to the 200-day moving average, which is around 66, or even lower to these levels, which are about 65. But this is what we would anticipate in the Australian dollar, in the New Zealand dollar, and in the Canadian dollar, which all in all is bearish for commodities and basically it's saying that commodities could be having a serious retrace over the next few weeks. And this is what the commodity charts are in fact showing you. It's showing you that we've had a very nice rally, and we could easily have a 10 to 15% break back in commodities, which would probably give us what we want with the Canadian dollar, the Australian dollar, and the New Zealand dollar. Just a few words about some websites and some articles which we found interesting over the past few days. This story by Zero Hedge about Stan Druckenmiller we think is a must read. We have a very high regard for Mr. Druckenmiller because we have never bested him. Every time we've come across him in the market, we've had to run for our lives. He's extremely, extremely good. He's probably one of the guys we respect the most out there. He's talking about the final endgame, nothing that is going to affect trading for the next 2, 3, 4, 6 months. He's looking much, much, much further ahead. This story is a must read because basically he is saying that we are coming to an end of a 30 to 40 year cycle, and that it's time to buy gold and forget about everything else, i.e. it's time to go into a wealth preservation mode and forget about returns. Again, we don't think that this is going to affect trading in the slightest over the next few months. But read it, see what you think of it. We have a very high regard for Mr. Druckenmiller because he has been so right so often in the past. And finally, one more website we'd like to recommend is this one, eurobondonline.com/ratio. It gives you the tick moves for the futures so that you know what 1 basis point is worth, and it gives you the ratios between 5-year notes and 2-year notes, 5-year notes and 30-year notes, ratios between Schatz and Bunds. It's very good. You can mark it in your favorites, and then when we are talking about certain trades, you can refer to it and you can see what the ratios should be and why we're doing certain contract sizes in one contract against another, and so on. Finally, we would like to share with you what we're looking at as a potential leader over the next several weeks, and that is the EEM, the Emerging Markets ETF. It led the move up in S&Ps by several days, by several weeks, and that was, this contract was one of the essential reasons why we got long of the S&P when it was trading in the 1800s and low 1900s. It turned much earlier than the S&P, and also it has marked a top earlier than the S&P. Looking at it, basically we are coming to very important levels. We're coming back to the 38.2 retracement, and we're just above this pivot point, 31.61, that we think is going to be very, very important going forward. At the moment, this looks actually quite bullish. We could easily have a move back up to the 34 area, 34 to 34.60. The RSIs are extremely oversold, therefore, a bounce is favored. And that is actually one of the reasons why we're currently not short of Canadian dollars or Australian dollars, and we are doing nothing as yet in the Australian dollar, because we recognize that the chances of a bounce from these levels are quite good. But if the bounce goes no higher than 34.50, we will be making out a head and shoulder pattern in the emerging markets ETF, which led the S&Ps and the DAX up, and now could be leading them into a period of consolidation. And then should it break this line around the 3160 area, it could be leading them on the way down. So we are looking at this ETF primarily to lead the market both on the upside and on the downside. Again, mark these levels. They're going to be very important. 3160 on the downside and around 3460, 3450, 3460 on the upside. Should it break this level, then there will be no head and shoulders, obviously, and actually, it'll be another bullish period for risk on equities, and quite possibly a bullish period for Canada, a bullish period for Australian dollars. So we'll let this contract decide our trading. As our current positions go, they're being very much tempered by Stan Druckenmiller. We recognize that we are in a trading market at the moment, and that the end game could be coming within the next 6 to 8 months. If Mr. Druckenmiller is right, it's going to be quite a move. Therefore, we are beginning to consider switching some of our investment wealth into this product, and we are beginning to think about trading much smaller size within the current trading ranges and buying some long-term options. But we will update you on those when we find something which is worth doing. At the moment we don't see anything, but we will certainly study it over the next few weeks and share anything that we have found with you. The one thing that we have done for our pension funds is we have switched away from riskier contracts into healthcare, where we see the only rise in forward earnings, and we have switched again away from the stuff that we were quite long of, and that is the energy index, and we have switched away out of consumer staples and switched away from consumer discretionaries. We just don't trust those. So we are much more long on a long-term basis in healthcare than we were, fortunately, and we are beginning to buy some information technology very much for the long term, because we think that the future belongs to technology. So that is all we're doing in terms of allocating our wealth, and we think that the next 3 to 4 weeks are going to be trading weeks, and we very much look to trading the markets as opposed to positioning for any long-term moves. So we will do smaller size, and we will look for shorter time frame trades to basically make 20-30 points in the S&Ps or 100 points in the DAX, as opposed to trading it for the long term. Thank you very much.